Disclaimer.
They call me AG, and I have got one foot in Asian markets and the other in American finance, which means I am watching silver trade at $73 in New York while my contacts in Tokyo are paying $130 for the exact same metal. Somewhere between those two prices is a truth that is about to reshape everything you thought you knew about our financial system. Picture this. You're sitting at your computer in January 2026, looking at silver prices on your trading screen. The number flashing back at you says $73 per ounce. Seems straightforward, right? Now imagine calling a dealer in Tokyo to actually buy that same silver. The voice on the other end quotes you $130, not 73, not even close, 130. You'd think someone made a mistake. You'd think arbitrage traders would immediately pounce on this opportunity, buying the cheaper American silver and selling it to Japan for an instant $57 profit. That's how markets are supposed to work. That's how they've always worked. But here's what should grab your attention. Nobody can close this gap. The world's most basic market mechanism has completely fractured, and we're watching it happen in real time as 2026 begins. Let me put this in perspective. When you see that $73 price on your screen, you were looking at what traders call the paper price, the number generated by futures contracts trading on the Comex exchange in New York. These are agreements to deliver silver at some future date, and most of them never actually result in physical metal changing hands. Traders settle in cash, pocket their gains or losses, and move on. It's been this way for decades. The paper market and the physical market have always stayed reasonably close because anyone could theoretically demand delivery and bridge any gap that opened up. But something fundamental changed as we entered January 2026, and most Americans haven't noticed yet. On the very first trading day of the new year, Comex faced a record-breaking demand for actual physical delivery. We're talking about 7,330 contracts. That's 36.65 million ounces of silver, all demanding settlement in a single day. To understand how extraordinary this is, consider that this represents 30% of the entire free-floating supply available for trading. 30% in one day. Here's where it gets interesting. The Comex has two types of inventory in its vaults, eligible and registered. Eligible silver is stored there, but not available for delivery against futures contracts. Registered silver is what actually backs up those paper promises. Throughout December 2025, something alarming happened that set the stage for our current crisis. Registered inventory drained by 60%. Think about that timeline. Just as we approach the January delivery window, the metal that's supposed to be available for delivery largely disappeared from the vaults. Now we're in January 2026, and the mathematics become impossible to ignore. You've got massive delivery demands hitting an exchange with depleted inventories, and suddenly those paper contracts are being tested like never before. The people holding those contracts want their silver, not cash, not promises. Physical metal they can hold in their hands or store in their own vaults. Pop quiz. What happens when a dealer in New York gets a delivery notice, but the warehouse tells them allocation will take 2 weeks instead of the usual 48 hours? What happens when that same dealer realizes they can't source wholesale silver for less than $80 while their screen still shows $73? They're caught in a vice. They've sold paper promises at $73, but replacing that paper with actual metal costs them $80 minimum. That's a $7 loss on every ounce, and it's not getting better. You might be thinking this sounds like a temporary supply chain hiccup. Shipping delays happen, right? But walk through the actual logistics with me. Let's say you're a large dealer who just got assigned delivery on 500 contracts. That's 2.5 million ounces you need to produce. You start calling refiners. They quote you $82. You call international sources. They're at $85. Plus you're now dealing with war risk insurance surcharges that didn't exist 2 years ago. Global shipping routes through certain maritime choke points now carry premiums because of geopolitical tensions. Then there's the warehouse allocation issue. You're told your metal might take 10 to 14 days to clear and be available for delivery. Meanwhile, your counterparty who demanded delivery is sitting there with a contract that says they paid $73 and they expect their silver within the standard settlement window. You're bleeding money on every ounce, and the arbitrage that's supposed to fix this situation can't function. The profit opportunity exists on paper, but nobody can execute it fast enough or cheaply enough to make it work. Have you noticed what's happening in Asian markets? While we're still pretending silver trades at $73, ordinary buyers in Tokyo are paying prices that would shock most American investors. Secondary market platforms in Japan are showing silver between $125 and $130 per ounce. Not for rare collectibles or special mintages, for standard 1-ounce rounds and bars. The same products we can theoretically buy for $73 here in America, except we can't, because dealers don't have inventory at that price. This isn't just a Tokyo phenomenon. Throughout major Asian financial centers, street-level physical silver prices have detached from Western spot prices by $30 to $50 per ounce. In Singapore, Hong Kong, and Shanghai, buyers are routinely paying $95 to $110 for immediate delivery of physical metal. They're not stupid. They're not getting ripped off. They understand something that many Western investors still haven't grasped. The paper price and the physical price have become two different markets, and the gap isn't closing. Think about this scenario. You're a Chinese manufacturer who needs silver for your electronics production. You've got purchase orders to fill, assembly lines running, and you need metal delivered to your facility within the next week. Do you care what the Comex screen says? You care about one thing. Can you get physical silver delivered to your factory, and what's it going to cost? When you call suppliers, they're not quoting you $73. They're quoting you $90, maybe $95, depending on quantity and delivery timeline. That's the real price in the real economy where actual silver changes hands. What if I told you this gap has become permanent? Not temporary, not fixable through normal market forces, but structurally embedded in how our silver market now functions. The logistics breakdown preventing arbitrage isn't going away. War risk insurance costs aren't decreasing. Warehouse allocation delays aren't improving. They're getting worse as more contracts demand physical settlement. The traditional mechanism that kept paper and physical prices aligned has fractured, and we're entering uncharted territory. Here's what this means for us as Americans, watching our investment portfolios and our currency's purchasing power. That $73 number on our screens isn't reality. It's a fiction maintained by a paper market that's increasingly disconnected from the actual economy. Real transactions are happening at $80, $90, even $130 depending on location and urgency. The longer this disconnect persists, the more violent the eventual repricing becomes when our paper market is forced to acknowledge physical reality. The Comex market opens every morning. Prices flash across millions of screens, and most traders assume those numbers represent true market value. But underneath those digital displays, a massive stress is building. Record delivery demands, depleted vault inventories, widening gaps between paper and physical that arbitrage can't close. We're watching the foundation crack in real time, and most people are still looking at the pretty facade without noticing the structure beneath is failing. January 2026 isn't just another month in the silver market. It's the opening act of a repricing event that our financial system has been postponing for years. The question isn't whether this gap will close. It has to eventually. The question is whether it closes by paper prices rising to meet physical reality, or by the paper market losing credibility entirely and forcing everyone to recognize what silver actually costs in the real world, where actual metal changes hands between actual buyers and sellers. You're holding dollars right now. Those dollars can theoretically buy silver at $73 per ounce, according to futures markets. But in practice, in the real economy, they're buying you silver at $80 to $130, depending on where you are and how quickly you need delivery. Which number do you think represents the true value of silver? Which number do you think represents the true purchasing power of your dollars? And what happens when everyone else starts asking these same questions at the same moment? Now, let me show you exactly why this gap is not closing and why 2026 is different from every year that came before. We need to talk about what happened on January 1st, when most Americans were nursing New Year's hangovers. China flipped a switch that changed the global silver supply chain forever. On the first day of 2026, Beijing implemented a new licensing system for silver exports. This was not a surprise. They announced it months earlier. But the impact is only now becoming clear to Western markets. Before January 1st, hundreds of Chinese companies could export refined silver. Small refiners, medium-sized operations, independent traders, all could ship silver overseas if they met basic requirements. As of January 1st, that entire ecosystem collapsed into just 44 state-approved firms. Think about what this means in practical terms. You're a European industrial buyer who's been sourcing silver from 3 different Chinese suppliers for the past 5 years. Reliable relationships, good pricing, smooth logistics. January 1st arrives, and suddenly 2 of your 3 suppliers can't export anymore. They're not on the approved list. They still have silver. They still want to sell to you. But Chinese customs won't let it leave the country unless it's moving through one of those 44 approved channels. According to analysis from major commodity research firms, this consolidation is projected to trap 60 to 70% of Chinese refined silver domestically throughout 2026. Let me put that number in perspective for you. China produces roughly 20% of the world's refined silver. If 60 to 70% of that production stays in China, and all indicators suggest it will, we're talking about 12 to 14% of global supply that's suddenly unavailable to Western markets. That's roughly equivalent to 40% of the silver that normally flows into American and European industrial and investment demand. You might be wondering why China would do this. The official explanation is about quality control, environmental standards, and consolidating the industry. But walk through the strategic logic with me. China is the world's largest manufacturer of solar panels, the largest producer of electric vehicles, and rapidly building out AI infrastructure that requires massive amounts of silver. Every solar panel needs silver paste for electrical contacts. Every EV needs silver in its electrical systems and battery management. Every data center needs silver in countless components and connections. By keeping more silver inside their borders, they're securing supply for their own industrial future while our supply gets tighter. Here's where the mathematics become brutal for Western markets. We're entering the 5th consecutive year of supply deficits in the silver market. The Silver Institute projects the 2026 shortage will land somewhere between 149 and 295 million ounces. That's not a typo. At the low end, we're short by roughly 15% of annual mine supply. At the high end, we're talking about a deficit equal to nearly 30% of what comes out of the ground each year. Have you noticed how fast artificial intelligence infrastructure is expanding? Major tech companies are racing to build data centers, each one requiring exponentially more computing power than the last. According to industry reports, AI data centers in 2026 will require 30% more silver than 2025 installations. That's not 30% more data centers. That's 30% more silver per facility because the chips are more advanced, the cooling systems more sophisticated, the power management more complex. Now layer on solar energy. Governments worldwide have set aggressive clean energy targets for 2026. Solar installation projections show a 15% increase in capacity additions compared to 2025. Every megawatt of solar capacity needs silver, and there's no substitute that matches silver's electrical conductivity and reliability at the temperatures and conditions solar panels endure. The International Energy Agency data shows we're not slowing down. We're accelerating solar deployment even as silver supply tightens. Then there's the electric vehicle boom. Major automakers have 25% production increases planned for 2026 compared to last year. Each EV contains significantly more silver than a traditional internal combustion vehicle, somewhere between 25 and 50 grams depending on the model and features. Multiply that by millions of additional vehicles rolling off assembly lines this year, and you're adding tens of millions of ounces to annual industrial demand. Pop quiz. What happens when industrial demand is growing by double-digit percentages while mine supply increases by maybe 2 to 3% annually at best? What happens when the world's largest manufacturing economy decides to keep its silver at home instead of exporting it? You get a supply deficit that can't be filled by increased production because new mines take 5 to 7 years to develop, and there aren't enough new projects in the pipeline to matter for 2026. But here's what should really grab your attention: the evidence that Comex itself is showing cracks in its foundation. Remember those vaults I mentioned earlier? The registered silver inventory that backs up futures contracts? According to Comex's own publicly available data, registered stocks have fallen 73% since 2020. Think about that timeline. Over 5 years, while industrial demand exploded and investment demand surged, the metal available for delivery against futures contracts dropped by nearly 3/4. Let me show you what stress looks like in the vault mechanics. Lease rates, the cost to borrow silver for short-term delivery, hit 200% annualized in the fourth quarter of 2025. 200%. That's not a normal market condition. That's a scarcity signal screaming at anyone paying attention. When it costs you 200% annually to borrow silver for a few months, what does that tell you about how difficult it is to actually source physical metal? Then there's backwardation. In normal commodity markets, futures contracts trade at a premium to spot prices because of storage costs, insurance, and financing. You're paying a little extra to lock in delivery at a future date. But when physical supply gets tight enough, that relationship inverts. Spot prices rise above futures prices. Traders call this backwardation, and it's a massive red flag. In Q4 2025, silver backwardation reached $3,000 per contract. That means people were willing to pay a $3,000 premium to get silver now, instead of waiting for future delivery. Have you ever seen 3 major stress indicators hit simultaneously in a commodity market? Registered inventory collapsing, lease rates spiking to usurious levels, deep backwardation pricing immediate delivery at huge premiums. Each one of these signals alone would concern market analysts. All 3 together? That's a market approaching critical failure. History gives us context here. When commodity exchanges face this combination of stress indicators, they typically respond in one of 2 ways. Either they allow prices to rise dramatically until new supply emerges and demand moderates, or they change the rules. They might allow cash settlement instead of physical delivery. They might adjust margin requirements. They might modify contract specifications. The London Metal Exchange did exactly this with nickel in 2022 when prices went parabolic and threatened to bankrupt major participants. They simply canceled trades and changed the rules. What if I told you Comex might face that same decision in Q1 2026? Not as speculation, but as a logical consequence of the mathematics we're watching unfold. You've got record delivery demands hitting depleted inventories. You've got a supply chain that can't arbitrage away the price gaps. You've got industrial and investment demand that isn't moderating. And you've got an exchange that's supposed to guarantee physical delivery, but increasingly can't source metal at anywhere near the prices its contracts specify. Think about this scenario from the exchange's perspective. You're Comex management, watching January deliveries strain your system. You see February contracts already showing heavy delivery intentions. You know March will bring more of the same because buyers have lost faith in cash settlement and want physical metal. At what point do you acknowledge that the paper market can't function anymore at prices that don't reflect physical reality? At what point do you either let prices rise to true market clearing levels or change the rules to protect the system from collapse? The evidence isn't hidden. It's all public data. Vault inventories are reported weekly. Lease rates are published daily. Contract delivery notices are tracked and disclosed. Chinese export regulations were announced in government documents. Industrial demand forecasts come from the companies themselves in earnings calls and investor presentations. The Silver Institute compiles supply deficit data from mine production reports and fabrication demand statistics. Everything I am telling you can be verified by anyone willing to look at the actual numbers instead of just watching price screens. Here's what makes 2026 different from previous years when Silverbugs predicted supply crunches that never materialized. In previous cycles, we had buffers. If industrial demand spiked, above-ground inventories could fill the gap. If investment demand surged, mining production could ramp up marginally. If one region faced shortages, global logistics could redirect supply from other areas. Those buffers are gone now. Above-ground inventories have been drawn down year after year of deficits. Mine production can't increase meaningfully in the short term. And global logistics are fractured by the very factors we discussed: China's export controls, warehouse delays, insurance costs, and geopolitical shipping risks. You're watching the proof accumulate in real time. Asian physical premiums aren't temporary, they're widening. Comex stress indicators aren't moderating, they're intensifying. Supply deficits aren't shrinking, they're expanding as industrial demand accelerates. The gap between paper and physical is not closing through arbitrage. It's becoming permanent as the mechanisms that should bridge it fail to function. This is what a market looks like right before repricing. Not panic, not chaos, but mounting evidence that current prices don't reflect current reality. The participants who understand physical supply chains are paying $90 to $130. The participants still trusting paper markets are thinking $73 is real. Both can't be right. One of these groups is about to learn a very expensive lesson about the difference between price discovery on a screen and price discovery in the physical world, where actual metal changes hands between actual buyers and actual sellers who need it for actual use. Now, let me show you the timeline that matters and why the next 90 days will determine who profits from this repricing and who gets left holding worthless paper promises. We're not talking about someday or eventually. We're talking about Q1 2026, January through March, as the convergence point where multiple forces collide simultaneously. You're watching January delivery pressure hit right now. Those 7,330 contracts demanding physical settlement aren't an anomaly. They're the beginning of a trend. As dealers struggle to source metal and face losses on every ounce they deliver, word spreads through trading networks. Other contract holders see the stress and decide they want physical settlement too before the system locks up completely. February manufacturing restocking hits next. Industrial buyers who run lean inventories need to rebuild stocks for spring production schedules, and they're discovering their usual suppliers can't deliver at anywhere near screen prices. Then comes March, and this is where it gets really interesting for anyone paying attention to our mining sector. Silver mining companies report earnings quarterly, and Q1 results hit in late March or early April. Think about what those earnings reports are going to reveal. These companies have been selling their physical output into the real market, not the paper market, throughout Q4 2025 and Q1 2026. When you're a mining company with actual silver coming out of the ground, you don't sell at Comex screen prices. You sell at real market prices, where buyers pay premiums for guaranteed delivery of physical metal. According to conversations I'm hearing from industry contacts, miners have been achieving $85 to $95 real prices for their output. Some are getting even higher depending on their delivery terms and buyer relationships. Now picture what happens when these companies report Q1 earnings and analysts start calculating actual cash flow per ounce. The numbers won't match the assumptions Wall Street has been using to value these companies. Here's the calculation that matters. Mining stocks are currently priced as if silver trades at $40 to $50 per ounce in real economic terms. That's the implied assumption built into their valuations, based on historical margins and cash flow models. But when Q1 earnings hit and show companies generating cash flow based on $85 to $95 realized prices, the algorithm that values these stocks has to reset. And that reset doesn't happen gradually, it happens overnight, as trading algorithms adjust their models and institutional buyers scramble to reposition. What if I told you silver mining stocks might be the highest torque play available for the first half of 2026? Not silver itself, but the companies producing it. When a mining stock is valued at $50 silver, but the company is actually selling at $90 silver, you're looking at potential overnight revaluation of 100 to 200% once the market recognizes the disconnect. The physical metal might move from $73 to $100, a 37% gain. But a mining stock properly repriced for $90 realized prices, that's a different magnitude of return entirely. This 3-month window from January through March is critical because it's before mainstream financial media catches on. Right now, most analysts covering mining stocks are still using outdated assumptions about silver prices and margins. They're modeling these companies based on Comex screen prices, not physical market reality. When Q1 earnings force them to update their models, you'll see price targets revised dramatically upward. But by then, the move will already be underway. The smart money positioning now, in early January 2026, is capturing the full repricing. The money that waits for CNBC to explain it will be buying after the sector has already doubled. Think about this scenario from an institutional perspective. You're a pension fund manager or a hedge fund analyst. You've been avoiding silver mining stocks because at $73 silver, the margins look tight and the risk reward doesn't justify a position. Then March earnings hit, and you suddenly realize these companies have been printing cash at $90 effective prices for months. Every dollar of silver price increase above production costs drops almost entirely to the bottom line because mining costs are relatively fixed. A company producing at $30 per ounce that sells at $90 is generating $60 of cash flow per ounce. That same company valued as if they're selling at $50 looks absurdly cheap the moment you update your assumptions. Now let's talk about where silver prices themselves are headed, because the timeline is more compressed than most people realize. $100 per ounce becomes the psychological breaking point, the number that forces mainstream institutions to recognize silver as a Tier 1 reserve asset alongside gold. When silver trades at $70 or $80, institutions can still dismiss it as an industrial commodity with investment characteristics. When silver trades sustainably above $100, that dismissal becomes impossible. Have you noticed what happens during psychological breakpoints in markets? The velocity of price movement above a major threshold is typically faster than the climb to reach that threshold. Silver moved from 50 to 100 over several months of grinding higher, breaking through resistance and consolidating gains. But the move from 100 to 150, that's measured in weeks, not months, because it's driven by fear of missing out and panic buying from participants who finally understand what's happening. According to my analysis of the current setup, we're likely to see $100 per ounce by Q2 2026, sometime between April and June. That's not a prediction pulled from thin air. It's based on the convergence of factors we've been discussing. January delivery pressure exposing Comex weakness, February industrial restocking hitting tight supply, March earnings revealing mining company cash flows. Each of these events progressively erodes confidence in paper prices and forces more participants to seek physical metal regardless of cost. Once $100 breaks and holds, the psychology shifts entirely. Pension funds that have allocation mandates for precious metals start including silver in their rebalancing. Family offices that focused exclusively on gold start diversifying into silver. Sovereign wealth funds that bought gold throughout the past decade start questioning why they ignored its sister metal. And retail investors who watched Bitcoin and gold make new highs start piling into silver as the affordable, precious metal play they can actually accumulate in size. This is where velocity matters more than fundamentals. The move from 100 to 150 is not driven by supply deficit calculations or industrial demand growth. It's driven by FOMO, fear of missing out, and recognition that everyone who dismissed silver for the past 5 years was wrong. Price movements driven by psychology are faster and more violent than moves driven by fundamentals because they're not constrained by gradual supply-demand adjustments. It's pure capital flows chasing momentum. But here's what you really need to understand about the endpoint of this repricing. Not everyone holding silver exposure is holding the same thing. Some people own physical metal in their possession or in allocated storage where specific bars are assigned to them. Some people own unallocated silver accounts where they have a claim on silver but not specific bars. Some people own paper contracts on Comex. And some people own ETFs or other derivatives that promise silver exposure. When the system comes under enough stress, when delivery demands exceed available supply and exchanges face potential default, the distinction between these different forms of silver ownership becomes critical. Comex has force majeure clauses in its contracts that allow cash settlement if physical delivery becomes impossible. Unallocated accounts can be settled in cash if the institution doesn't have enough physical metal to cover claims. ETFs can suspend redemptions if they face liquidity issues. Only physical ownership or fully allocated storage gives you certainty that you'll actually receive metal at settlement. Think about this scenario playing out in real time. Silver hits $120. Comex delivery demands overwhelm available registered stocks. The exchange invokes force majeure and settles contracts in cash at current prices. Holders of paper contracts receive $120 per ounce in cash settlement. Meanwhile, physical metal on the street is trading at $150 because anyone with actual silver knows the paper market has lost credibility. The paper holders got $120. The physical holders can sell at $150. That $30 difference is the cost of trusting promises over possession. This is the generational transfer that occurs during market dislocations. Wealth moves from people who trusted the system to people who understood physical reality. It's not about being smarter. It's about recognizing when market mechanics break down and positioning accordingly. We're watching those mechanics crack in real time. The evidence is mounting daily. The timeline is compressing rapidly. And the choice is binary. Are you holding paper promises that might get cash settled at paper prices? Or are you holding physical reality that trades at physical prices? For us, as Americans, managing our portfolios and protecting our purchasing power, this isn't about panic or fear. It's about recognizing structural changes in markets we thought we understood. The silver market operated one way for decades. Paper and physical stayed aligned, arbitrage worked, and Comex functioned smoothly. That world is ending. The new world features permanent bifurcation between paper and physical arbitrage failure and exchanges facing existential stress. The question isn't whether to believe me. The question is whether you believe the evidence accumulating in vault inventories, delivery demands, global premiums, Chinese export controls, and supply deficit mathematics. I'm just connecting dots that are already visible to anyone willing to look. What you do with that information determines whether you capture this repricing or watch it happen to others while you're left explaining to yourself why you didn't act when the signals were clear. We're 90 days into what might be the most significant precious metals repricing of our generation. The fracture between Tokyo pricing and American pricing isn't healing, it's widening. The question you need to ask yourself right now in January 2026 is simple. Which price do you think represents reality, and are you positioned accordingly? If this breakdown helped you see what most are still missing, hit that subscribe button. I'm tracking these market fractures in real time, so you don't have to choose between staying informed and staying profitable. Drop a like if you want more intel from someone who's actually watching both sides of this trade, and I'll see you in the next one when we count how many more cracks appear in the system.